do to launch a coin is go and reply to any tweet and say at Launchcoin and with a ticker, and then it's there. And the internet capital market thesis is pretty simple: being able to tokenize anything on chain, right? And Solana is really trying to be the home of that. And go back to what you're saying, Dylan, being what is built on top of these networks. And some of the stats from the Believe scanner: lifetime volume is $2.6 billion, 21,000 coins have been launched. The total market cap of all coins on the platform is around just shy of 400 million, with about 230 of that coming from Launchcoin. What's up, everyone? Welcome back to Shoot the Shit number 5. I'm your host, Matthew Nade, joined by the enterprise team here at Messari: Chris, Kenji, Dylan, Sunny, and Andrew. We pretend to be macro investors. We're going to debate about some L1s, how they should be valued, the internet capital market narrative, a Hyperliquid bear case from the world's biggest hype bull, and then we're going to finish off the episode with some DePIN corner and what we're doing on chain. But to kick it off, we'll start macro and see how we're doing. Had a crazy weekend move. If we look at the week, S&P up 1.8%, almost has a 6 in front of it. Bitcoin dominance, a little flat, up to 2% on the week. Gold down pretty flat actually on the week. And then if we go over to crypto, Bitcoin up 2%, ETH up 1, Sol down 5. Little discorrelation there, and Hyperliquid up 5%. So what are we seeing in the markets? How's everyone doing? I know we're seeing some bullish deals with President Trump of the Middle East, but it looks like the trade narrative, Liberation Day might be fully past us. What are we seeing? What are you guys thinking?
Well, we had the Moody's credit downgrade over the weekend. I think futures were down like 1%, and we've just like totally continued to brush off all bad news. I think you could argue like the credit downgrade is like not super informative. It's like pretty backward looking. Like obviously based on like the current proposed spending bill, like I think our deficit to GDP is going to be like 6.5%, which is enormous. So like the market knows that the government's going to continue to spend a bunch of money, which historically has been good for, nominal GDP and for risk assets. I think it's hard to like make a narrative at this point of like how much risk is being discounted, one, on the tariff front anymore, and then on the front of like people kind of exiting treasuries or US denominated assets, which is like no longer really happening. And this isn't like the way overall like stock market indices are acting. This isn't like a US specific thing anymore too. Like most developed market indices are like either at highs or above prior all-time highs. So I don't know, people have bought the dip extremely aggressively, and I think in either scenario it kind of seems to be boding well for Bitcoin. I think if we continue to just like spend super aggressively, that's going to probably do well, probably filter through to Bitcoin continuing to do well. So
yeah, I have no idea what's going on anymore.
The Sunday action was absolutely schizo. We tagged like 106, we dropped down to 103, and then we pumped to 107, and then dropped down to 102, and now we're back at 105. It was like the most aggressive schizo Sunday price action, which I think like when we're doing that just before a prior all-time high, I kind of tend to think that's like low time frame shakeout before we actually break to the upside. Like that's kind of how I'm leaning right now. What do you guys think?
Yeah, I mean, all the smart people I know on this matter are not that bullish risk assets in the short to medium term. I've seen a lot of reasons for why things could get worse. I mean, I kind of thought that companies would be sandbagging earnings a little bit harder, kind of taking advantage of the macro uncertainty this quarter. I've seen it materialize for some companies, but for the most part, like everyone seems to be churning along just fine. And I mean, management teams aren't usually the best indicator for like forward-looking macro turns. Like they tend to just be taking backwards-looking trends and just kind of like moving it forward based on seasonality. And so it's kind of tough to read into what they're expecting. And so that could always turn for the worse. But I have no idea what's happening. I don't know what justification there is for indices to be this high when everything seems to be incrementally worse since the last time we were here. But I am feeling very bullish on Bitcoin, at least. I think the fact that we were able to break like 100K almost quietly when like everyone was sidelined, when the market wasn't overheated, when there wasn't anything specific to Bitcoin that was really causing like a reason for rampant speculation, makes me think that this might actually be like the real 6-figure break for Bitcoin. And so I'm just kind of taking a view here that I am specifically bullish on Bitcoin and as a result, like alts as well. But it's hard to say that like if everything goes to the shitter like everywhere else, like we won't be insulated. But I have no idea what's happening anymore outside of crypto. So no macro commentary from me.
I have no commentary, but I have a question if someone wants to indulge. Wait, so Andrew, are you just saying that like yields are rising based on the downgrade? Because it feels weird that yields are so high when last time they were this high, everyone was calling like something's broken and we need intervention. And this time, there's like no chatter about it.
I think, yeah, it's also confusing because the last time we had a credit downgrade, I think yields initially went up and then people got scared about risk assets in general. And so people actually I think they piled back into treasuries and yields ended up lower on the day. I think that was either there was two downgrades. It was one in 2023 from Fitch and then one all the way back in 2011, which I was not trading for. But yeah, it's funny how we could be at the same yield levels, but people's interpretation of it and their reaction to it is totally different based on what stocks are doing. I feel like when we were initially at 4.5% on the 10-year on the way down, it was oh shit, everyone is selling treasuries and stocks and the dollar. And that's a scary situation. Here it's everyone knows that the US fiscal and credit situation is technically deteriorating and has been deteriorating for a long time. And on the counterbalancing side of that, it's the government spending money, that kind of eventually flows through to nominal GDP and dollar denominated assets like stocks. Usually that's the correlation. So I think it's slightly less worrisome in the second scenario versus the first one. I think if we end up at some point revisiting that dynamic of dollar down, treasuries down, stocks down, then I think people will be more concerned with where the level of yields again. But for now, it's that's no longer the dynamic, at least for now. I have no idea if that's going to return or not, but yeah.
How do we feel about Coinbase joining the S&P today? I just checked their chart. They're up 51% on the month. Is that pretty awesome that everyone in their brokerage account is now going to have exposure to crypto a little bit? Is this good for the whole industry? Is this only good for Coinbase? What are your guys' thoughts on them joining the S&P?
I think it's just fun. I like having some crypto presence, the S&P. Every single boomer now is going to be DCAing into crypto exposure, whether they know it or not. So happy for that. And honestly, I'm pretty I like this little cohort of publicly traded crypto companies that we're slowly building out. It feels like they're slowly starting to make their way onto the scene. I mean, it's either crypto companies that are pure plays like Coinbase or Galaxy, or they're existing fintech companies with some sort of crypto vertical / exposure. So your Robinhoods, your PayPals, and whatnot. And so I don't know. It just helps from a mindshare perspective to have all of these tickers in front of Wall Street and everyone who's buying equities pretty consistently, and they're now forced to kind of look into these things and understand what's happening. And maybe that means that the traditional stereotypes around what crypto is from a degenerate perspective, all the fart coin headlines, whatever, maybe there's less of that down the road within the overall conversation. And maybe as you have sell side analysts, buy side analysts, forced to look into, okay, what's actually happening in crypto? What are the secular tailwinds? What can we invest behind? Or maybe it's a company that they're already invested in that just added some sort of crypto vertical and now they have to look into it. It's a good way to get people to to become familiar with all of the positive developments from an institutional level that I think have mostly been ignored, or at least that side of crypto progress has been sort of drowned out by all the fun, degenerate, bubbly stuff that we like to focus on. But there is a lot of real stuff happening, and now everyone has to pay attention. I know that Stripe stablecoins presentation got a lot of people excited as well. A lot of fintech analysts I know, or software analysts, TMT analysts, listen into that call and was kind of introduced to the stablecoins narrative for the first time. And so, yeah, just bullish in general that we have so many crypto exposed / crypto adjacent or just crypto pure play companies now on a large scale in the public markets.
I don't actually think it's that different from before. I think the analysts, every like large TradFi firm has analysts looking at, or not every, but a good amount have analysts who have looked at Coinbase before. And they don't necessarily understand the underlying business. I think we can see that a lot of the quarterly, earnings estimates. I think they're familiar with it. Like even the most conservative firms, like they'll pay attention to publicly traded companies that are worth, tens of billions of dollars. I think like this is just part of the broader, I guess, gradual acceptance of crypto by TradFi. I think it is like, a milestone, but I don't think like it's gonna like cause a sudden spurt of interest in crypto and really diving deep behind what drives Coinbase. I think this is just part of the gradual adoption of crypto.
Well, actually, I was looking into, so for like part of the Coinbase report that we do at Messari, I was able to get my hands on like a couple of sell side earnings previews, and they were actually looking at things that like we would look at, just maybe not as in depth. So they were like, there was commentary on like proof of stake, commentary on stablecoin market cap. Like some people were looking at volumes, like even DEX volumes, to try to get a sense of what's been happening with Coinbase. So that's, I think, bullish, because these are terms that, like, if you're a sell side analyst and Coinbase has now been added to your coverage, like you're forced to look into these tailwinds and you're forced to look into these terms. And so like it's now part of your job to do so, which I think is nice. And they're slowly like getting better at it over time. Like if you look at the types of questions that were on the earlier Coinbase earnings reports, like they were very, very, yeah, I mean, they were pretty novice questions, but I think over time, like these guys are smart people, like they'll get better at it. And so I like now that there's this almost like forced inclusion of like crypto narratives into these people's like daily job habits. Like it's now part of their criteria, now part of their mandate. And so, yeah, I think maybe it's not like some drastic change in how people are going to perceive the industry, but hopefully over time, there's like more education around like core crypto subject matters.
Sonny, did you beat the street? Did you keep Kunal's legacy going on?
No, I did not. But I think it was like a really interesting quarter for Coinbase. So we were actually able to identify through like Messari internal sex data that XRP had put up like a monster quarter for Coinbase, and they were actually like 11% of total Coinbase volumes in Q1, which led us to believe that like that would drive a mix driven beat, because retail margins are so much higher than institutional margins. And like the key is really figuring out like how much of Coinbase volumes in the quarter came from retail and how much came from institutional clients. And I think looking back, like the macro deterioration with the tariffs probably caused a ton of retail to risk off in a more of a dramatic way than we expected. But, through the XRP number or through the XRP line item, we kind of thought that maybe that was an indication that retail actually showed out stronger than it really did. But Coinbase did break out XRP volumes for the first time this quarter as a specific line item within their shareholder letter. So yeah, kind of a mixed bag. Either way, if you read the report, hopefully you learned something, and we'll get better at it over time.
There we go.
So did they miss on retail volumes, or?
Yeah, they missed retail volumes, overall revenues, and I think like pretty big miss in EPS, which we don't do. We stick to revenue projections, but yeah, March was, I would imagine, a pretty bad month for them.
All right, let's kick it over to how some other things should be valued. A little discourse over the weekend, bringing back is economic security and meme, monetary premium, and then REV, new metric kind of on the scene over the last six to 9 months. For anyone not aware, REV just aggregates all transaction fees on the network and then also out-of-protocol fees. So, for example, on Solana, that'd be like MEV tips to the Judo validators, or any MEV that's going on like with flash bots on the Ethereum network. And the camp from ETH is saying that the ETH maxis are going to kill REV. So what do you think? Is REV a good metric to value these L1s? Should we go back to the economic security? And what are your guys' thoughts there?
It's not a good metric for ETH. That's all I'll say.
Yeah, I'll pull up some metrics. Ever since, ETH was killing it ETH was killing the REV chart, just dominating until about October of last year. Then ever since then, Solana's been dominating. Even though this last week, there's been 78.5 million total in REV, and 40.2 of that is coming from Solana. Obviously, in that week when Trump launched, Solana was killing the game. But so it might just be a changing of the narrative, and that's why the ETH maxis aren't a fan of it. But what do you think in general about how to value these L1s?
I think I have 3 different directions we could go on the REV discussion. I think the first one is just like, is it a good metric? Objectively, I would say yes, but you have to contextualize it of, it's best for things that want to be an execution environment, and you probably want to compare that across chain. So just, a random REV metric doesn't do a lot for you. I think the more interesting discussions are around, is it important for ETH? And should you be using it in your L1 valuation? I think I'll start with the valuation side. I think the fact that it's a debate proves that no one knows how to value an L1, right? Like you can argue, or you can, how do I say it? Like part of the reason a DCF works isn't just because like it's logically sound, but also because everyone agrees like this is how we value an asset. But when you have a bunch of disagreements about what is the actual model that you build to value something, that shows like there's different market participants that view it or view the fundamental value like very differently. So there's definitely a cohort of users that like want the economic security, want the censorship resistance, want the monetary premium. And then there's also this cohort like REV discounted cash flows. And so if you have multiple people, then you can't really use a single one to describe value. So you'd have to figure out what the mix is, or take a very long-term view that the end state, however we value this assets, is going to be like one of those 3. And I just don't think that's a conversation worth having. Like I'd rather let the market play it out. Also, like even if you decided like REV is the end state, like that is the fundamental value we'll be using in 20 years, like the only actual trade on that is like short things. Like I don't know what else you could do. So that's that point. Maybe I'll pause there if anyone has like thoughts on that.
I'll jump in. I think what's interesting with these 3 metrics, the monetary premium, REV, and economic security, is that all 3 are driven by the underlying applications built on the chain. So any growth in underlying application, whether that be value and users, that's what's driving all 3 metrics. So I think there's actually almost unanimous agreement that what's being built on chain is what drives the value of the chain in the long run. Where I think the disagreement lies is on value capture. So like, is it straight off of fees, which you can do more of a DCF like valuation in the long run? Is it a monetary premium, which gets a massive relative valuation to a stock-like asset because it's used by money? Or is it some kind of baseline economic security level where the chain has to be worth X amount in order to protect all the assets on the underlying chain? I don't think like we really know what that value capture mechanism is. Like I think because there is so much disagreement, no one really knows. My personal view is that the L1 premium, getting a monetary premium, trying to become some kind of world reserve currency, I think that's the only valuation metric that can justify the multiples that these chains are trading at. But I do think like all 3 do depend on just underlying application growth. And I think what everyone's debating is what makes most sense for valuing this asset, like for perceiving this asset's value capture. And it does matter because, like I said, like you can't like a DCF, like doing it based on stock multiples, like I don't know if like these L1s could ever catch up. And I don't think the ratio to value capture in terms of fees is really ever going to catch up to volume. Like I think that's a very misguided perspective that we can really grow at that rate, especially since fees are going to continue to compress over time. And then, my personal view is economic security doesn't make a whole lot of sense. We can get more into why that is, but I don't think it actually provides baseline value. I think it's just a theoretical requirement that would never really work in practicality. So yeah, I think like that's my broader view. Application growth drives the growth and value of the underlying asset, but how it captures that value and why it does, I think, is more of the underlying debate.
But then, like, would you say that Bitcoin's a special snowflake then? In that case, it doesn't need applications.
I think okay. So my view is Bitcoin. It's trying to fight for world reserve currency. It's a gold. It's a store value. It's digital gold right now, but it can also become world reserve currency in theory. Bitcoin, it has unique properties just in terms of timeline, just people holding it, just already having more value. That gives it an advantage over these other L1s. And my view is that these other L1s, through having smart contracts, through having other, applications, over time can have that digital asset across borders type narrative that's similar to Bitcoin. Maybe it has some weaknesses in terms of not being a scarce asset, although I think Bitcoin might have to increase its total supply cap at some point. So there's some debate there. But I think having this economy, this digital economy of applications, gives something like Ethereum or Solana potentially more value if you're comparing all the attributes of the ideal type of money in the next 20 years economy versus Bitcoin, which is kind of just the static asset on chain. So I don't think, like, through my framework it makes sense. Other people, if you're looking at it through Rev or whatever, are gonna have to look at it completely differently.
I think that there's something to be said for, I don't even know if you bucket this into decentralization, I guess, but like settlement. So if you're sending a massive sum of money, take fees out of the equation. Would you rather that transaction settle on Bitcoin, or would you rather settle on a chain where they can then roll back the chain at some point? Not to call out Hyperliquid, but sorry, it's just one of the most recent examples of it, where you can just go and say, okay, hey, that trade actually didn't happen at that price. It happened at this price. I think that that's maybe something that people aren't taking into consideration, or maybe they are. Maybe the market is pricing that in, right? But I think when we talk about parts of chains that are commoditized, like we talk about executions commoditized, we say block space is commoditized, right? But like, is settlement actually commoditized, or does that add a premium knowing that this is going to settle in a way that is super secure over time? It is not going to get rolled back. This is the final arbitration of this transaction.
I guess just to quickly touch on economic security, like that's a value proposition for a user of the chain, but it doesn't actually, like, there's nothing underpinning the valuation of the native asset on that chain. Like, there's no incentive for token holders or potential market participants to support the asset price of like a native token in order to like sustain some arbitrary level of economic security. And so I do think that you can use it as a, like, hey, like, it does matter if you're a user, especially if you want to be like a long-term user of a chain, like what the economic security of that chain is. It's going to introduce variance if it's not economically secure. Like, nobody wants to have to go through forks and rollbacks and like social consensus all the time. And so as a user, you would want to like keep your funds or idle your funds somewhere that you feel like a destination that's backed by like a substantial amount of economic security. But that doesn't work from a valuation perspective, because there's no reason at all for investors and token holders or validators to participate in this like arbitrary line of economic security. Actually, like, the inverse would probably happen. Like, as you approach this level of, okay, this chain might not be economically secure, people would probably dump their tokens in like a bank run like scenario, like on a reflexive way out. I think, to touch on Kinji's point though, you also can't just shill a valuation method like into existence. Like, if there are 30% of people who believe that monetary premium should exist, then a monetary premium will exist to some extent. Like, and if you, I think it's a great conversation to have, because we do want to understand how to value L1s, especially on like a forward-looking basis. But the reality is, like, today people are buying these assets not because of REV, but because of like relative like comparisons to either like Ethereum or Solana, or to Bitcoin, or to other assets out there in the world, and how much liquidity exists and how much liquidity will change moving forward. Like, these are all things that today, if you're a buyer of Solana, you're thinking about more so than the REV of the network and how that's going to change going forward, unless you're like a fundamental investor or a research analyst. But I think you're probably in the minority if you're in that camp. And so it's really tough to see how this plays out. I am interested to hear your third point before I give my take on REV, Kinji, in case it's relevant.
Yeah, sure. It was just going to be about, like, there have been some ETH maxis just saying REV doesn't matter for ETH. So it's like a very Ethereum specific conversation, but to me that's like insane cope. So if you are Ethereum and you're taking the model of, we want to be the like roll up hub for everyone to kind of build on top of, if you like boil it down to like the dumbest product offering that you're offering to those rollups, the product is the market cap. Like the security comes from the market cap. And if you have a low market cap, you have low security, people are going to go somewhere else. And you need REV to support that market cap for whatever reason. So if you buy the REV discounted cash flows idea, then you need REV for people to bid that asset. Just like the way ETH works, you need REV for the burn to happen to get like a monetary premium. So if you don't have a bid for the asset, you don't have a long-term sustainable product. And right now, REV is probably one of the better metrics out there to get people to bid the asset. So I just think that's a crazy take that like REV doesn't matter for Ethereum. It definitely does. But that was my little rant so people know we're not ETH maxis.
Yeah, completely agree. And I think REV does make a lot of sense. Like if you just boil it down to first primitives, like maybe that's not how the market is really viewing these assets today. But I think in terms of like, if we can eventually reach consensus on how to value L1s, I do think REV is probably in the lead right now. And I think it'll probably make up like a large part of, like, maybe there are some people who ascribe to monetary premium. Maybe there are some people who are valuing these assets as like on like a relative basis to Bitcoin. I know most people like that are crypto native today don't really put like smart contract platforms and Bitcoin in the same camp. Maybe some like TradFi investors are. And so they're always going to be in like the same, everyone's going to be in this like diaspora of what they believe like an L1 should be valued. But I do think REV is probably the front runner for being like the fundamental way to value L1s. And it makes a lot of sense. I think like if you have validators that are securing the network, and theoretically anybody that can get to like whatever the minimum hardware specifications are can run a validator for one of these networks. And if they can run a validator and they can make like X amount of money, or they can expect X amount of like revenue per year based off of REV, then that's like a fine way to value an asset. I mean, I kind of did like a similar thing with Aerodrome where, look, not everyone is staking Aero, but the people who stake Aero get paid this much. And those people are going to drive like the fundamental valuation of the token, because there's always going to be someone that can theoretically lock up their Aero tokens to receive that revenue and to receive that cash flow. In the same way that theoretically, in a world where Solana is generating like trillions of dollars a year in REV and there's like no validators, there's going to be somebody who's going to spin up a validator to capture that revenue, and they're going to drive like some sort of fundamental underpinning to the SOL token, because you need to stake the SOL token in order to have a claim on those cash flows. And so I think it's like actually a great way, if you think cash flows do matter for L1 valuations. I think it's probably going to be a more and more relevant metric as we go forward. And I do think it's a weird conversation when you think about how it looks strange, because like people always say that like, how can you use REV when REV is going, or like every single team, like the Solana Foundation, the Ethereum Foundation, they're trying to get REV to essentially zero because they want to lower the cost of the user. And that's true like today. But I do think that like these L1s are not going to sustain if they're not generating fees to validators. And so at some point, teams will have to come to terms with, okay, what is like where do we end up? Like, where do we find the balance between making sure there's enough economic incentive for validators to help secure the network while the actual usability of the network remains like low cost? And there probably is, if you believe in like the future of smart contract platforms, there's going to be like a profitable balance somewhere. And so I think if you look at something like base sequencer fees, which is like a very easy way to just kind of get a sense of like revenue and how that changes with scalability, like base sequencer revenue topped in March 2024 after Ethereum launched EIP 4844. And then at the same time, Base started like launching their scaling initiatives to like basically increase MGAS. And sequencer revenues were down only for like a period of like 5 to 6 months, but have since like dramatically resurged as base like transaction activity has picked up. And so like that's a perfectly fine equation to use. I think Mert like tweeted something similar where like, yeah, your take rate is lower, but the amount of activity on the chain is going to increase exponentially, and that's going to balance out in the end. And I think that that's like a fair argument.
Does it balance out? Like people say that, but like you run the math, you're like, I don't think it does. Like I think you get a further compression in fees, and like I don't think the multiples ever add up. Like I don't know what your take is on that, but like when Mert says that, like I don't think the math adds up.
I mean, if you believe that Solana is going to become like the decentralized NASDAQ or the hub for internet capital markets, then I think it does add up.
Okay, but like what's NASDAQ worth?
I have no idea, but I think that like Solana's TAM is probably way larger than NASDAQ.
I'd say Solana is worth a lot more than NASDAQ as is. And yet NASDAQ does way more transaction volume than Solana. So like, yeah, this is why I don't think we can do it off Rev.
Well, you could use REV. What you're saying is basically just if we use REV, all L1s should be worth less, which is fine. Like that's still using REV as a valuation metric.
Yeah, that's what I'm saying. But I don't think anyone who likes REV as a metric wants to be like, oh, we're actually massively overvalued and will never be accurately valued if we use REV as the metric.
Yeah, I think that's the Guart argument, which is, okay, if we're going to use REV, all of your tokens are basically overvalued, which I think is a fair take as well. It's just a difference in time horizon, and a difference in assumptions and growth projections, which works. Like you can use REV to be bearish on L1 tokens as well. Like a valuation metric can go both ways. And so, yeah, I think just to basically summarize, like I do think it's the best metric I've seen so far. Not to say it's like a perfect metric, and not to say that like it will actually end up winning out as like the preferred valuation method for L1s, but I don't get why people would criticize it. Like I think it's a fair premise.
I think the critique comes in like where the valuations are. Like I agree, Rev is probably the most accurate way to value these chains. But if it is, like that's kind of a disaster. I think that's where the real debate starts. Is that we need a different way to value these assets that can justify much higher prices, where Rev will just never get us there.
But isn't that just cope? Yeah, like aren't you just saying L1 tokens are overvalued? Because I think the people who are touting REV have done the math and believe that they can get there, like on a growth standpoint. So you just have a different opinion than them on like where the actual growth for like smart contract platforms will pan out.
Yeah, I mean, I think I disagree that the growth will ever pan out. And then I look at what are the alternative ways of looking at this asset. And I also try to look at, okay, like it is priced at this current price. Like people can do the Rev calculations. Maybe they believe it, maybe they don't. But it is at a very elevated price relative to Rev potential. So then, like, are there other factors at play? And then that's where I think the further debate comes in of, is it a monetary premium? Is it economic security? Is it something else no one's thinking of? So I think like that's where the debate heads, but I don't think there's any contention on like Rev is like nonsense. Like I think based on like how businesses work and are valued, it makes by far the most sense. And it's probably the highest likelihood. But if it does have the highest likelihood and it does become Rev is the standard, that's very concerning for valuations if you don't accept the math on the potential Rev capture.
So are you also saying that because the REV math doesn't work out today, it's indicative that the market already is not abiding to like the REV valuation
Well,
method?
I mean, maybe the market thinks that math will work out. I don't know, but it might not. So I think like it's we shouldn't be dismissing anything but Rev at this point and just assuming that the market's pricing in what it thinks Rev can grow to.
So I just want to play devil's advocate for 2 seconds. Even though I agree on the high level, like the valuation should probably be some sort of weird sum of parts of like REV discount, monetary premium, like censorship resistant, like someone that sounds like a fun 6 months project if anyone wants to go out and do that. But on the devil's advocate side, if you assume that there will be sufficient demand, then like shouldn't all block space come to like a pricing equilibrium? And if you have a very cheap chain, then it's just going to be filled with garbage that'll eventually get REV up until that block space is accurately priced.
Can you rephrase the question? I'm not sure I caught it.
If we assume I'm saying there's a world where price is no longer a differentiator. We all align on like, this is the price for certain block space. So let's say Solana, Mega ETH, Base all come to like a similar end state, then all their pricing should be relatively the same. And if pricing ever isn't, then it'll get pushed up. So like you can constantly have REV like just growing based on a market equilibrium of price, block space price.
Yeah, but I think real estate matters, right? So like an apartment in New York is not going to be worth the same as like an apartment in Houston, Texas. Like I think
which chain's which?
Yeah, well, I'm not going to comment on that. But yeah, like I think there is going to be like a premium that some L1s are going to be able to charge based off of the either like differentiated application ecosystem that they can offer, or like the differentiated like technical capacity of the chain, or it could be economic security. But I think there will be like a way to differentiate these L1s. Like I don't think it's going to be as commoditized as people think. And maybe it's commoditized from like a pure block space perspective, but there are also intangible things that can influence like the value of your L1's real estate, just like the job market and the cultural scene of like New York and LA have influenced like real estate prices. I think the same can happen for like L1s.
Yeah, I mean, it's like what tokens are on your blockchain, right? Like who wants to trade them? What apps are they going to use? Like that's why you bridge to a blockchain, right? You bridge to trade a token like 90% of the time. So
Yeah,
how close
am I to a Trader Joe's or a Whole Foods? That type of stuff.
That's important, and that's a perfect segue. You guys are doing my job for me into internet capital markets. Sonny, you brought it up, and like the applications that are built on top of these.
Wait. No.
You want to keep going? We can keep going.
I think we could spend some more time on REV, honestly.
Let's go. We got it.
Okay, like sure we can say like rev goes up, but like does like what like is the value capture ever going to get to the point where we could justify either existing valuations or like what we hope the valuations to grow to, which I think is most important? Because I think like the real like problem here is based on current valuations, it already seems relatively like very far-fetched that we could like justify valuations if we're comparing them to stocks. Like if we want Solana to 5x, 10x, 20x, like is there any potential there? Like even if we're NASDAQ and every single exchange, everything, like can it ever get there on fee capture?
Well, have you like I think there are people who agree that we're actually not trading too expensive for a lot of these tokens. And so on REV basis. And so Matt, like I know you just did like the quarterly report for Solana. Like what are like the most recent REV multiples if you've looked into them?
Yeah, I saw someone tweet about it. It was like 26, 27x, which is similar to what Ethereum was back in like Pico Top 2021 when the NFT crazy mania. And then
that's close to, yeah. Go ahead, Matt. Sorry.
Yeah, that's growth tech. I mean, you guys would know better than I am, but that's growth tech multiples. And then also another little cool fact is like applications on the network are earning more than that. I know that's the whole Microsoft product or protocol, their platform thesis as well. But yeah, the multiples aren't crazy when you really look at them.
Yeah, 26. I think 26x, 27x. That's not even too far off from like the medium Nasdaq or median like QQQ multiple. Like you're getting in like fairly valued range here. I think for some of these assets. If you think Solana can 10x over the next like 5 to 10 years in terms of like activity and app revenue and all that stuff, like that's fair. I think it doesn't work for most L1s, but for something like Solana, which is kind of an REV powerhouse, or even for something like Hyperliquid, which is a revenue powerhouse, the valuations are not too far off from where they should be, in my opinion. So I think some people would probably disagree with you on the math, Dylan.
Do you know what Hype's multiples are?
I can check that right now.
Pretty sure Hype, like, I don't know in this context or framework what REV would be considered, but PE wise, I think last time I looked it was like sub 15, which is just straight up cheap.
Yeah, like
Hype.
Yeah, go ahead, Andrew.
Justifiable in any possible scenario, and you don't need to build in any crazy growth assumptions that volumes are gonna 5 to 10x or anything. So cheap, yeah.
Hyperliquid is trading at 260 billion in FDV right now. They're doing on a daily basis like 2 to 4 mil. So even if you say they end up averaging out to like $1 million in fees per day, that's like 365 million in annualized revenue, which is it's like less than a 15x multiple. It's less than a 10x multiple.
You meant 26 mil, right?
Yeah. I was like, wait, 260? No.
Oh, 26 bill. I'm sorry. But yeah, that's less than a 10x multiple.
Maybe one day 260, but for now 26. Dylan, any rebuttal, or you want to go into the internet capital market narrative?
I think like we could probably end the discussion. Does the math add up? Like I think there's also like if we continue compressing fees, like if we look at Q4 Solana versus Q3, like fees were like twice as high, right? Just because of higher demand. Like in the long run, with like all these adjacent chains, like can fees really get there? I think like there is a case. I don't disagree. But I don't think the upside is really there. And I don't think for most investors, like the kind of upside they want to see in these L1s are there if we're just going to go off of Rev. Like I think we're in a very like tight zone that doesn't leave a lot of room for error. And that's a little concerning. So I think like that's my view. But overall, Rev makes sense as a metric. I think application growth, like usage growth is what's driving growth in the base asset across Rev, monetary premium, economic security, and it's really just a debate over what's possible and how much value capture can you get as a base asset. And with that, I'll let Matt transition.
Perfect segue right again back into the applications on top of the network. The narrative that was big last week, internet capital markets kind of kicked off with this Believe app and Launchcoin. And so we saw, I know internet capital markets been a really thing that the Solana teams have been pushing and seeing on Twitter, but the crypto Twitter universe really took it by storm last week with Believe and Launchcoin, and where they were able to, basically all you could do to launch a coin is go and reply to any tweet and say @Launchcoin and with a ticker, and then it's there. And some of these and the internet capital market thesis is pretty simple, being able to tokenize anything on chain, right? And Solana is really trying to be the home of that. And go back to what you're saying, Dylan, being what is built on top of these networks. And some of the stats from the Believe scanner: lifetime volume is $2.6 billion, 21,000 coins have been launched. The total market cap of all coins on the platform is around just shy of 400 million, with about 230 of that coming from Launchcoin. So I guess the question is, what do you guys think about internet capital markets in general? Is Believe the true definition of internet capital markets? Well, I know we put out a piece late last week on the discussion piece on it. I tend to think differently. I think internet capital market seems something different, but we can get to that later. And curious to think what you guys think of this narrative that has been brewing in the last couple of weeks.
Yeah, I think from a narrative perspective, like, we have to separate what Solana, Multicoin, and a lot of other people have been referencing as internet capital markets and what this recent narrative has contextualized internet capital markets to be. I tend to agree with you that I don't think that this is the true definition of internet capital markets. I think that this term was just taken and people ran with it. I think maybe it's like a little seedling of what internet capital markets could be, but I think it's very far away from the final iteration that we're all looking for from internet capital markets.
Yeah, I think there was like a host of complaints about, one, like this being another kind of meme coin launchpad, two, the quote unquote companies that launch on it, users like explicitly don't have any claim to any cash flow or ownership in some form of equity, which is like kind of, I think, the main point of like ICM in some respect. I do think maybe it's a decent next step. Like, I do think the founders like trying to work in ways to like use an API to make it easier for people to incorporate some token utility into whatever product they're shipping. Thus far, like, I don't know about you guys, I haven't seen any launch that's been like particularly interesting. I know there were some issues with like creator or founder payouts as well. I think those might have gotten cleared up, but I think, yeah, I kind of agree with what Chris just said. It's like maybe we're moving slightly, marginally in the right direction towards something more legit and less meme coiny, but I kind of think we're just like slapping a new name on it for the most part, which, I mean, I'm not bearish on in isolation. Like, I think this, like, as a main part of this like little meta, like, could keep going for a bit. I haven't played any of the actual like product launches or tokens at all. Just I figured I'd just own Launchcoin and see what happens. But that's basically my take.
I might hijack the conversation a little, but so I feel like everyone knows that like internet capital markets, like the idea pushed by Solana and Multicoin, is cool, and Launchcoin is like kind of attached to that idea, but it's not it. But is anyone like slightly concerned, because I am slightly concerned, that we had the market anoint this meta and it only ran to like 300 million? Like, it feels like normally the market will just choose something, and it does, like, the end game doesn't matter for it until you get bigger, right? Like, once you cross a bill, maybe you start thinking about, okay, like, is there another 3x here? You're gonna have to convince new buyers that are probably more fundamental focused. But the fact that, when you're small, it's almost a measure of speculative capital, like how much juice is there, and we didn't run that high.
Well, I think the
reason was because we didn't put out the fractal. That was probably why we did as far as we could. Because the AI meta, we pushed a couple tokens.
We'll go to zero.
Yeah.
Oh,
Okay,
I
sorry,
agree
what were you
though.
saying?
Well, no, yeah, I mean, I think like that's exactly it, right? Like people saw the fractal, and people were expecting the fractal earlier this time. Like we all kind of knew the playbook going into this, and I think that you look at the structure of Launchcoin, and it's a token launchpad asset issuance with something that is very loosely tied to an end product, and the market's not dumb. I mean, that happened to what we topped in January from then. Like, yeah, we have short-term memory, but that's pretty recent. So I think people looked at this structure and saw they overlaid virtuals onto it and said this is very, very similar. When a consensus happens like that, you're going to speed run the topping of that. So it's like, yeah, it's, however high virtuals ran, I think because we understood kind of what the end game might be, we're just front running that end game. It just didn't have the juice to go higher.
Which, by the way, we don't know if it's topped yet. Maybe by the time this episode is out, it's at like 3 billion.
Fair.
But yeah, like I agree. I think everyone that I know kind of just saw right through this almost instantly and came to the same conclusion, but went, we'll partake anyway because like the timing is good and there isn't a new meta to speculate on at the moment, which I don't think is concerning because I think if something came around that got people very excited at that time, there probably would have been enough juice to push it higher, or maybe it still comes. I don't know. Maybe there's like a second wave of announcements of like super bullish developments from the team. But yeah, like I think the problem was more in the meta itself.
Also, I do think each time we do one of these, like there is a layer of extraction involved, like whether that's through snipers or through trading bots clipping their 1% fees in and out. And if you think about it that way, like every time we're doing volume on one of these metas, it's like there's just liquidity being siphoned out of this pool of like on-chain capital into the hands of like basically just a few people, which is net bearish over time. And I think we need like another buildup of kind of like a wealth effect from either BTC or majors to kind of trickle back into these like on-chain metas. But on net, like the market has done nothing but get smarter and faster, and people know the game, and that kind of, yeah, it like stops everything way earlier than people are hoping for. I don't see why that's going to change unless we get another BTC all-time high break, and hopefully some people actually own BTC now, and then they have money to speculate. Hopefully some people learn their lessons, like myself included, to own more BTC. So
I think for alts, even like you kind of almost want to track like Sol and Hype, because those are kind of like, if you're involved in alt in some way in this space, those are probably your two comfy holds that everyone is kind of on board with. And so yeah, like if those start weakening, might be a problem for these one-off like upstart metas. But like if Sol goes on like a massive run to like, I don't know, 300 or something, like I imagine everyone gets right back into the game.
yeah, and I think right now my base case would be just, I would expect Hype to outperform Sol, just like size-wise, and it's just not as well distributed or well owned. But I think the wealth effect from Sol going up would be much, much higher than from Hype going up. So, I mean, I want to see Sol go up, even though I don't have much of it.
Yeah, kind of into that. We can roll into Sonny. What was your bear case for Hyperliquid? Just talking about needing Hype and Solana and some of these alts going up, and you're the biggest bull I know on Hype. So what was that? What was your bear case? I know you tweeted about it, but let's talk about that a little bit and say, hey, we really like Hyperliquid, but hey, there's this one little thing that we're kind of keeping notes on and keeping track of.
Yeah, it looks like people kind of responded to this idea decently well on Twitter, and I've been thinking about it for a while now. And it was like this, somebody, I forget who it was, basically posted, hey, are there any like good bear takes for Hyperliquid that we haven't considered? And I looked at my Twitter and I was like, I think I've just like rifled off like 50 straight Hyperliquid boltard posts in a row. And so I should probably try to be an objective research analyst here and like put out into the world this like bear case that I've been thinking about, that I know other people have been thinking about it too. Like I kind of formed this with talking with some people who I know are also holders. But essentially it's this idea that like Hyperliquid's growth so far, which I've been giving the team like massive credit for, as you know, like I've been shilling Hyperliquid for a while. I've written 4 reports on it, on why it's been so successful. But you can almost argue that its success has, a lot of its initial success might have come from low-hanging fruit, which is just, there was no great perpdex product. Perps have PMF. A lot of people like perps, could like perps, and it's a natural fit with like most of the people who are speculating on chain today. And you just needed the right product with the right founder, with the right community to come around and aggregate all of that activity and potentially even expand the pie a little bit within the on-chain crowd. And I think Hyperliquid has done that. And you've basically seen like an up and to the right chart in terms of like Hyperliquid to Binance volume share. And I think that probably continues for a while going forward. Once you start maxing out the amount of on-chain retail liquidity there is for perps, which is probably, I think, smaller than most people think, then Hyperliquid hits this threshold where it either has to try to win over more sophisticated flow, whether that's like HFTs, institutions that currently are on like centralized exchanges, or you have to expand the pie significantly for on-chain perps, where you're like actually winning over people, net new users who were not perps users, but are now entering the space and using Hyperliquid for the first time. And I think the latter is going to take time and the former is going to be incredibly hard. And so I do see this point where the exponential growth we've seen in like Hyperliquid volumes relative to centralized exchanges hits this wall at some point where it has to like expand into a much harder to win user cohort that it doesn't have access to currently. And that the amount of money that could flow into on-chain perps right now, we're kind of almost hitting the limit, you could say, or at least approaching the limit of how much Hyperliquid can grow just off of the latent demand there that exists like right now in crypto for Hyperliquid's product. And so that's kind of the bear case that I see that could materialize in the mid to near term, which I think can be, it's more of a hurdle than anything. Like I think it's just something that people aren't really thinking about right now. And when it surfaces, like Hyperliquid could out execute its way to victory still. But I just don't think right now enough people are discussing it as like a potential point of slowdown for Hyperliquid's growth trajectory. And on like from a competitive standpoint, there are way more clubs now, on-chain clubs that are launching that are optimized for like HFTs, market makers, like sophisticated flow right from the get-go. Like I've covered GTE, it's one. Like Lighter, for example, has like 5 millisecond end-to-end latency, which is like right where Binance is. And that is obviously going to appeal to market makers and HFTs who are used to that level of speed. But it's also going to be hard for them because now they need to win over the retail user base that Hyperliquid has won. And that's going to be like a way tougher task for them than it was for Hyperliquid. And so I see it mitigated in both ends where, yeah, I think it might be harder for Hyperliquid to penetrate into like the 20 to 50% range of like Binance share in terms of volumes. But at the same time, it is now materially harder for every other new on-chain club to try to get to Hyperliquid's level of dominance in the on-chain space because of how good Hyperliquid is and how happy like users on Hyperliquid currently are. And so I potentially see like this limbo state emerging where like maybe Hyperliquid's growth slows on the perp deck side, maybe some new competitors that are upstarts with more optimized order books come in or built on more optimized chains come in and like make this pitch that, hey, we're better than they are. But ultimately, you still need retail takers to be on your order book or else the sophisticated flow aren't like they're not going to make any money. And so it's this balance that you have to kind of strike if you're running an on-chain order book. And I just think that maybe like Hyperliquid's path gets materially more difficult like in the coming quarters. And yeah, that's basically the gist of the tweet.
The like fundamental question there, kind of clarifying, is basically, can Hyperliquid scale its performance to onboard HFTs before upstart clubs can steal a significant portion of retail flow, right?
Yeah, so what happens first? Like, does a better chain come in, takes like Hyperliquid's lunch money, and then also is like super optimized for all these higher end users that like trade in size and might carry like less margin for makers, but like is going to get you to like 50 to 100% share of Binance and get you that price discovery on chain? Or is Hyperliquid going to hold on to its lead and then slowly like execute its way to also attracting that user cohort in the future? And I think there's also like a third scenario, which I think is less likely, but people have floated, which is like, does Hyperliquid even need those users? Like, can it just become the people's like perp decks forever into perpetuity? And maybe that pie is actually larger than Binance's existing like pie. But yeah, like I think the way that you phrase it is generally correct. Like, can Jeff figure out how to optimize Hyperliquid even further? Or is somebody that is more optimized today or in the next 6 months going to come in and end up winning everything?
Kind of sounds like the upstart clubs are going to have to pay out a ton in incentives to get their retail flow over. Sounds kind of electric.
Yeah, I think it's going to be...
Looks like we're going to be seeing some ref links soon.
It's going to be a collab's golden age for farming, I think. If you're a perp trader, I think there will be like ample opportunities for you to like try some of these new products. But Hyperliquid itself has like a massive war chest in tokens that it can still deploy for incentives. So they've weaponized their token quite well.
I know you noted about some HyperEVM farms, and I think we'll save that for what you're doing on chain, because I want to get to DePIN Corner with Dylan. He just released another awesome report on DePIN Tokenomics Part 3 on what drives valuations, kind of a nice little nod to our conversation earlier. So are they using REV? What are they doing for valuations in DePIN? I know you were it was an awesome piece. So what's the gist of it, TLDR, and what is driving valuations?
Yeah, so we finally have like a level of revenue data within DePIN. I think we calculated 25 DePINs for revenue for the sample we used in the report. So the question we asked was, what is driving valuations in DePIN? Are fundamentals being considered, or is it more of the, mimetic value and other narrative-driven valuations that crypto usually sees? So we looked at 80 DePINs, 25 of which have revenue. We first kind of compared where do median DePIN FDVs and price to sales ratios compare to like L1s, L2s, DEXs, lending protocols, other DeFi protocols. And we found that DePIN lies right between base layers, so L1s, L2s, L3s, and then DeFi. So exchanges, lending protocols, etc. So why is that, right? So like, why is DePIN getting a higher multiple than DeFi, but a lower multiple than base layers? So we started digging deeper into the data. We first compared what we call physical resource networks to digital resource networks. Basically just means physical resource networks are more location dependent. They create more of a real world resource, so to speak. Digital resource networks are more like compute or file storage, purely digital, location independent for the most part where it's created.
What's an example of the physical one and the
so like a physical one could be like helium. So we'll call that like connectivity. We'll call it a real resource. Like it depends where it's created. Like you can only be covered if there's a device nearby you. So what we found is first DRNs have a 132 million mean FDV versus something like 36 million for PRNs. So we see a pretty wide disparity there. And we thought that was worth digging a bit more into, right? So why, they're all DePINs. Why do they have different mean valuations? So we looked at metrics like revenue, the cost of supply, which is how expensive it is to deploy a single node to a network. We looked at scalability. How many nodes can you basically deploy in a single area? Can you scale a network with capital versus a more geographically constrained? And basically, like, we get into the details, but in some, like, we couldn't see if any one of those factors really contributed. Like, we think all of them are factors to the difference. Like DRNs do generate more revenue. So like, I think something like 750K on average or on median for PRNs versus 1.5 million for DRNs. So they do generate more revenue, but doesn't explain why the FDVs are so much higher. Like DRNs tend to be more scalable, like you can fit more nodes in a single concentrated area. But again, like it doesn't really correlate to the difference. So we think like fundamentals are factored in. DRNs probably have stronger fundamentals at this point, just based on protocols that are live, but we can't really draw any conclusive conclusions based on why the revenues, why the FDVs are so different. So what we do after that is we look really into liquidity, and what we see is basically that protocols that have a lot of liquidity in DePIN trade at much higher multiples than similar protocols in terms of revenue, but lower liquidity. So if like a protocol is generating 5 million in revenue and has a lot of liquidity due to like a SEX listing or just for historical reasons, it's going to trade at a much higher multiple on average than a similar protocol of 5 million revenue but doesn't have a SEX listing. So it seems at this point, and it is early for DePIN, it's still like liquidity rules, like narrative rules, like maybe these DRNs are getting higher multiples because they're more AI adjacent with compute. Maybe people are seeing higher TAMs. Bit harder to draw correlations there. But yeah, we really can't say that fundamentals are really driving DePINs yet, but they're starting to make an impact. So, and I think overall fundamentals plus narrative is kind of placing it in this bucket between base layers and then DeFi. And we think At this point, like a lot of the larger DePINs came off of narratives pre-revenue, like Helium, Filecoin, Render. We think revenue is really going to drive valuations going forward, and that's what's going to lead to liquidity. Because obviously, if your price goes up due to more revenue, you get a SEX listing. Market makers give you more liquidity, and the overall story is narrative, as fundamentals will drive price, but at the moment, it's still traditional crypto and more liquidity-based factors.
I saw you had this recommendation section at the end. So what are your, I see you put it into like founders and investors. So what's your like recommendation to the DePIN community?
Yeah, so we basically recommend that founders basically plan around or take into account some of the variables we identify. So, if you're thinking about like how you should launch your token, you should think pretty hard about the liquidity, like how you're going to launch, what's the launch environment. Should also think about like how scalable is your network. Like we did see that the more scalable your infrastructure is, like the higher FDV on average you get. Like it's not fully clear if that's not causation, so it might just be a correlation. But if you're a sensor network and you can only deploy a node every 5 miles, like that might give you a lower premium on your multiple than another network. So we give a bunch of recommendations there in the actual report. And then for investors, a lot of it's just on trends. Like we say like pay attention to the kind of these same variables, like basically protocols that share certain qualities and similarities. And like I said, like scalability, the cost of supply, like they tend to be on the same trend line in our data. So you can kind of compare these protocols and kind of see where they should lie on a valuation basis more easily, just by looking at where other protocols with those characteristics are. And I won't share all the alpha, go read the report. But yeah, this was definitely one of our favorite reports so far, probably our most data intensive, and highly recommend checking it out.
Are we going to get a part 4?
We're definitely getting a part 4, yeah.
Be on the lookout for that. I love it. Let's get near the end of it. I know we're a little over an hour, but let's talk about what we're doing on chain. Chris, I know you've been talking about Time.fun. Are you bidding some minutes over there? Or?
I think you just put in the chat, right?
Yeah, Steve just wanted me to cover this because someone called it out on Twitter.
Oh, true. True.
It's kind of DePIN-y if you want to segue it that way, or I can just start talking.
Yeah, how's it DePIN? Is it the Bitcoin thing?
Yeah, it's the miners, so like there's physical infrastructure involved.
Cool. Yeah, I mean, speaking of physical infrastructure, I know Andrew, you just wrote a report over in Tau, and in the second report on Tau, talking about some miners, and so what are you seeing from the Tau DePIN or the physical miner stuff over there?
Yeah, so Subnet 14 spun up at like the end of April, and their alpha token like took off, and now they're basically in the number 2 spot by Tau emissions. So they're getting like 9% or so of daily Tau emissions, which is pretty huge. They're like the top performing subnet in the past month by a lot. They're like up like 8,000% or something. But yeah, the subnet is basically trying to decentralize Bitcoin mining. It's basically an alternative marketplace for hash rate. So miners, instead of going to a mining pool, they can basically direct their hash rate to the subnet towards various validators on the subnet, and then instead of getting paid in BTC, they get paid in the alpha token. And since the alpha token's gone up so much, it's actually pretty attractive for miners right now to be directing their hash rate here versus traditional mining pools. They've made this kind of clever incentive feedback loop. So the miners get paid for their hash rate in the alpha token through the daily alpha token emissions, and then they send their hash rate to validators. Validators can take that hash rate and basically do what they want with it. They can solo mine, they can send it to a mining pool and get paid in the traditional way. Eventually, the subnet owner's validator is going to run their own pool to get around all the different like centralized pools that you would tap into, or they can sell the hash rate to like a hash rate rental marketplace, which kind of like these alternative marketplaces where some people like arb hash rate depending on how it's priced on different venues. But yeah, so the validators get paid in BTC from their hash rate, and in order to continue getting the same proportion of hash rate on the subnet directed to them so that they can get paid in BTC, the validators generally need to buy more alpha token and stake it. because miners maximize their rewards when they direct their hash rate to validators who have the biggest stake. And so you get this like little loop where it's like, oh, alpha token goes up, miners get paid more in alpha token when you compare it in dollars to what they would get paid in traditional mining. And then once validators get paid in BTC, they're incentivized to buy the alpha token again to maintain the amount of hash rate they're receiving. And so that's this like little feedback loop has worked very well, just given that it's like the top performing subnet. There's been some like discussions on whether it's like a good use of BitTensor emissions. Some people are like, oh, like shouldn't we be, we're trying to like decentralize and give open access to machine intelligence to people. Why are we using this resource, this like the daily emissions to support Bitcoin mining? And my take there was just like, hey, this is like a very flexible incentive network that can technically be used for whatever. And there's an open marketplace where people are pricing whatever output miners are giving in a given subnet. So it's like, if it's not worth much to people to try to decentralize these mining pools, then eventually the market will price it accordingly. And for now, the market says it's a very unique and valuable service that they're providing. So it's like sitting in the number 2 spot. We'll see how long it stays up there or if it even overtakes shoots. But worth noting just because like it kind of sucked out all of the emissions from a lot of the other subnets. And so like some people were complaining, hey, like my subnet token's down in Tau. Tau's like stagnating the past few weeks or two with other alts. So we'll see if that maintains itself or the trend reverses there and some of the other subnets start outperforming.
I saw you took a screenshot of this tweet saying that subnets will mine each other the same way Tau Hash mines Bitcoin. You want to expand on that a little bit and see like what does that mean and what do you think is that actually going to happen and what's the implications or future pros and cons of that looking for Tau in general?
Yeah, that was from like Const, who's like the big figurehead in BitTensor. I think it's like useful framing because you might not think like any of the individual subnets, like maybe some of them are not particularly useful in isolation, but it's cool because they can all technically tap into each other when necessary. And they do sort of build on each other. I talked briefly on this in my Rayon piece, but there was some synergy between the 3 subnets that do like training and inference. There's this idea that like, oh, you could train a model on gradients and then you could host it on shoots. And then if it's really popular, you could host a model on 19, which does even faster inference. It's like, if you want the super popular model to be super responsive and fast, you can kind of follow that workflow. And yeah, like I think the way that subnets will tap into each other in the future and kind of make use of the outputs that they're giving out essentially for free or just in exchange for Tau emissions, that hasn't been fully explored yet, but it's like kind of a cool call option on future upside in the ecosystem.
I like it. Sounds super interesting. Looking forward to the next Tau report. And like Dylan said earlier, for the full alpha, go to Messari.io and read the report and look forward to Andrew's next report. But yeah, let's wrap it up here and we can all talk about what we're doing on chain. I'll kick it over to you, Chris. Talk about Time.fun. And are you bidding minutes or what else are you doing on chain?
Yeah, so I've actually been pretty active on chain this week. Time.fun is one of the things I've been checking out. I'm buying up people's minutes. I think some of the minutes on there are incredibly undervalued. You can have a minute of Kyle Samani's time for 88 cents. I think that's pretty well worth it right now. So yeah, you can find a lot of great deals around there. I'm buying it, it's half speculation, half like, I might actually want to talk to these people. So yeah, buying up some minutes. I've been using this app called Dripster.fun. Pretty cool app. It's basically creating markets around AI generated physical products. So I bought one of the little physical collectibles they have. It was $20 worth of tokens. You actually don't have to sell the tokens to claim it. So I'm basically getting a free product there. So that's cool. I'm waiting for that to come to my house. I've been checking out Collateralize, which is a cool mobile first app built on Solana around RWAs. So downloaded that, been peeking around there. And then per usual, I am active on Abstract Chain. So still messing around with all the consumer products on there.
So do you want to deep dive into your HyperEVM farms that you're messing around with over there?
Actually, I would say that's mostly Andrew.
Yeah. I started just thinking more about like, okay, well, one, we're going to get a season 3 of hype points at some point. Clearly, based on the staking tiers and the fees for volume, that they just put out, I think at the end of, when was that, May 5th or something? They like count spot volumes as double compared to perp volume. So I think it makes a lot of sense to, one, own some spot assets on Hyperliquid. I'm speculating completely, but like I think it will be like pretty well rewarded to like have some spot BTC on Hype, bridge it to the EVM. I've been messing around with like just basic DeFi protocols on HyperEVM, so Felix, Hyperlend, Hyperbeat. I think that I'm not like super bullish on any of the DeFi protocols like in isolation, but I think owning spot assets on the EVM there and then just doing some interacting with any of the apps there, I think collectively the individual airdrops plus possibly S3 points incentivizing EVM usage just like makes it a pretty attractive thing to do, especially if like you're just going to hold BTC somewhere anyway. You might as well do it on there. You can do some like low leverage or low like LTV borrowing against your BTC without much risk, and borrow against your Hype or BTC, mint some like FEUSD or USDT0, and there's some like interesting vaults on Hyperbeat that give you exposure to like multiple points programs, which I think that's pretty attractive right now, and I think it's actually pretty slept on. I saw there's only like 5,000 people, maybe like 5,500 people on Felix, so I think the HyperEVM, yeah, I think it's probably even more slept on than most things, so probably worth your time.
Dylan, what are you doing on chain?
Honestly, I'm just looking at the data as an analyst.
Someone has to. So one of us.
I'm doing valuations.
He's got no time to be on chain.
I'm trying out some new chains, but it's really all about the data. It's all about growing revenue. It's all about the fundamentals, and that's the objective right now.
I like it. Doing the researcher's work right there. I like it. Kenji, what about you?
I'm just comfy in Hype and Bitcoin for the most part. Buying some of my Bitcoin on unit to kind of Andrew's point, and then just waiting. I've been saying this for like 3 weeks. I feel like every podcast, I'm like, it feels like there should be a new exciting meta. We've had 2 kind of attempts at it with Launchcoin, Housecoin, and maybe the next one is the one that runs pretty hot. So just kind of being patient.
Sonny, want to wrap us up? What about you? What are you doing on chain?
I am foraying out of my hidey hole of stablecoins and actually looking at some spot alt positions in the trenches for the first time in a while. And so, yeah, I think if your thesis is we're back, or even if we're not back, even if we're just going to be in this limbo state for a while, then you can probably find interesting positions now that you want to put on that could pay out later on down the line. I mean, there was a chance to enter virtuals like months before it actually popped off. You could have been farming Hype months before it actually TGE'd. And so basically trying to find some opportunities there that I can maybe think about on a longer time frame basis than like a week. And yeah, I think like Launchcoin was fun, but sort of the one position I've been watching, which I really like the setup for. I'm not going to give the ticker out I'm not going to give the ticker out just yet, but I've been sitting on it for a while. As I guess a hint, it's on base and it has 10 million TPS, and I think it's particularly it might be one of the most slept on plays, one of the most slept on market opportunities right now. And if you think that tokens can't run high, like just go and find this chart. Like I think there's still plenty of liquidity for quality plays. I don't know if I can say the ticker. There is like a you are investing alongside one of the greats in the tech space, former CEO of a potential FANG company. Could be any one of them. Could be Microsoft. Could be.
I think we have to hit the not financial advice
not
disclaimer.
I was going to hit that. I was going to write into that. But yeah, I like the. It does have some legs, but that's interesting. I like the little alpha there. As always, as Kenji was saying, this is not financial advice. Do your own research. We're just research analysts, not financial advisors. But to go and read these guys' alpha and all their great reports, head over to Messari.io. Like, retweet, subscribe, wherever you find this podcast, the classic podcast ending. But this has been a great Shoot the Shit podcast number 5. Thank you guys for listening with us, and looking forward to being in your guys' feeds in a couple weeks. Thank you all. Peace.